Hello, everyone, and welcome. Today, we will explore a challenge that affects many successful families. The taxes they expect are not always the taxes that create the greatest damage. The costly surprises often come from the interaction among retirement withdrawals, investment gains, Medicare premiums, beneficiary rules, and the way assets pass to the next generation. Before we discuss strategies, I want to begin with one question that frames our entire hour. If you could see every tax consequence your current financial plan may create over the next 20 years, where would you expect the greatest surprise? Retirement income, investment gains, or the wealth your family inherits? Take a moment and choose one answer. There is no need to share it. The purpose is to identify the area that already creates uncertainty for you. Some of you may be thinking about a large traditional IRA. Others may be concerned about appreciated real estate or company stock. Others may be asking whether children will inherit wealth efficiently or receive a compressed tax bill. Keep your answer in mind because we will return to all three areas today. On a scale from 1 to 10, how confident are you that your retirement, investment, charitable, and estate decisions are coordinated to prevent avoidable tax surprises? A 10 means you have a current multi-year tax projection, a written withdrawal strategy, reliable cost basis information, coordinated beneficiary instructions, and a professional team reviewing the same plan. A 1 means taxes are mostly addressed after transactions occur or when the return is prepared. Write down your number. Do not grade yourself too harshly. Clarity is not a criticism. This score simply gives you a baseline. At the end, we will revisit it and identify the single gap that deserves the most attention. With that starting point established, let us begin with why tax planning matters today. Here are the key disclosures for this class. This program is educational. It is not a substitute for individualized legal or tax advice because trust laws vary by state and the right strategy depends on your assets, family, goals, and existing documents. Feel free to pause to read through these. For more disclosure information, visit our disclosure webpage listed here at the bottom. Here's a little bit about myself. My name is David Thurber, and I have been a financial advisor for over 20 years. I graduated magna cum laude from Troy State University while I was serving in the U.S. Air Force. I am a Desert Storm veteran. I worked on the flight line on F-15 avionics. I've been married for 30 plus years to my long-suffering bride Donna, and I have 3 children in the area. 2 are married, and we also have welcomed 3 grandchildren. I enjoy traveling, golfing, reading, tinkering in the shop with old cars. And here's a little bit about the firm that I represent and who created today's presentation. Strip Matter Wealth Management Group was founded in 2007 and is comprised of certified financial planners and fiduciaries. Education is our passion. We specialize in comprehensive financial planning, including tax planning strategies to help grow your generational wealth. Since education is our passion, here's a look at just a few of the free resources that we provide. You can find all of these and more on our website at stripmatterwealth.com. That leads us to the outline for our class. In the introduction, we're going to talk about why strategic tax planning matters today. We're going to help you reduce retirement tax risks, and we're going to create a tax-savvy withdrawal strategy. We're going to minimize investment taxes, managing gains, income, and charitable giving, and help you preserve your estate, protecting your legacy to leave more for your family. We're also talking about at the end next steps for turning today's knowledge into action. The objective contained in these 5 outline sections follow a natural education progression. This is how to navigate the information we'll cover today to get the most out of the class. Note that each lesson builds on the teaching of the lesson that came before it. This is designed to provide you with a complete mastery so you can turn these insights into powerful tax strategies of your own. Quick question. What do you want to take away from today's class? So take a moment, write down your personal learning goals for today. Feel free to pause here to give this meaningful consideration if you like. Let's get started. Our first section answers the question, why does strategic tax planning matter? Here we'll look at tax prep versus tax planning, why timing matters, the hidden tax exposure inside a 1 million plus financial plan, how taxes can compound across retirement for decades. We will separate tax prep from tax planning, uncover the hidden tax risks inside a 7-figure financial plan, and show how small tax inefficiencies can compound across retirement and your legacy. We're going to start with the difference between reporting the past and shaping the future. Tax prep is absolutely essential, but it is largely backwards looking. It records income, deductions, gains, losses, and transactions that have already occurred. By the time a return is prepared, the sale has closed, the distribution has been taken, the conversion window has ended, and many year-end opportunities are gone. Strategic tax planning looks forward. It asks whether income should be recognized this year or later, whether a Roth conversion fits inside a target range, whether appreciated stock should be sold, donated, or retained, and whether a withdrawal could trigger a Medicare surcharge 2 years from now. It also tests the effect on a surviving spouse and on the people who may eventually inherit the assets. Think of tax prep as the scoreboard after the game, while strategic planning helps choose the plays while there's still time to influence the outcome. The next question is where hidden exposure may already be sitting inside a plan with $1 million or more. A $1 million net worth does not automatically mean a family will owe federal estate tax. The hidden risks are often more immediate. A large traditional IRA taxed as ordinary income, a concentrated stock position with a low cost basis, a rental property with depreciation recapture, Social Security benefits becoming taxable, Medicare income surcharges, or an inherited retirement account compressed into a 10-year distribution window. There may also be state income taxes, state estate or inheritance taxes, outdated beneficiary forms, charitable gifts made from the wrong account, or a trust designed without coordinating the tax character of the assets. A portfolio statement shows market value. It does not show the tax claim that's attached to every dollar. That is why two families with identical net worth can have dramatically different flexibility. One may have taxable, tax deferred, and Roth assets, updated basis records, and coordinated beneficiaries. The other may have nearly all wealth trapped in one tax category. The numbers look similar, the choices are not. Now, let's see how these hidden costs can compound over time. Tax exposure rarely arrives as one dramatic bill. More often, it compounds through a chain of connected decisions. A large withdrawal raises adjusted gross income. Higher income then makes more Social Security taxable. It may trigger Medicare surcharges, push capital gains into a higher rate, reduce a deduction you are expecting, or increase the tax cost of a surviving spouse filing now as a single taxpayer. Investment taxes can compound too. Consider a simple illustration. $2 million growing for 20 years at 6% becomes $6.41 million. At 5%, it becomes about $5.31 million. That 1 percentage point difference produces a gap of roughly 1.1 million. This is not a forecast, and taxes are not the only source of return differences, but it reveals why recurring tax drag, that 1%, deserves attention. Legacy decisions add another layer. Gifting an appreciated asset may remove future growth from an estate, but transfer a low basis to the recipient. Retaining it may create different basis treatment at death. Naming a child directly on a traditional IRA may be simple, but the distributions could arrive during that child's peak earning years. The real objective is not to win any single or one tax year. It is to preserve more family wealth across many years, multiple accounts, and more than one generation. Let us place that chain reaction into a realistic retirement scenario. Imagine that you retire at age 65 with a large traditional IRA and several lower income years ahead, but no one models them. At 73 or 75, your required distributions begin. Social Security is already flowing, Medicare premiums rise, and the surviving spouse eventually files as a single taxpayer. Nothing in this scenario is illegal or unusual. The investments may have performed well. The tax return may have been prepared correctly every single year. The problem is that a valuable planning window quietly closed. During those early retirement years, the family might have evaluated deliberate IRA withdrawals, partial Roth conversions, gain realization, or charitable strategies. None of those actions would have been automatically right, but they would have been choices. Once mandatory income arrives, the number of choices can narrow. The most painful tax surprises are often not caused by a bad product. They are caused by a missed decision while time was still on your side. That leads to the first key principle for today. The first principle to remember is this: tax preparation reports the past. Strategic tax planning protects your future choices before the most valuable opportunities disappear. Whenever you face a major withdrawal, a sale, a gift, a conversion, beneficiary change, or a business transaction, ask whether the tax analysis is happening before the decision or after it. Timing is not a detail. Timing is often the strategy. Reflect on this. Are your major tax decisions being planned several years ahead currently, or mostly being reported after the year is over? Think of the name of the person who currently owns that multi-year conversation. Is it you, your financial advisor, your CPA, or no one in particular? A strategy without a clear owner often becomes a missed deadline. Now, we will examine how to reduce retirement tax risks through a tax-savvy withdrawal strategy. Next, we'll transition to reducing retirement tax risks, creating a tax-savvy withdrawal strategy which includes Roth conversions, when paying taxes now may save you more later, RMDs, managing the future tax burden on your retirement accounts, Social Security and Medicare, IRMA, avoiding hidden cost of higher income. This section answers 3 of the most common retirement tax questions. Should I convert to Roth? How can I reduce taxes on required minimum distributions? And how do income decisions affect Social Security and Medicare? We begin with Roth conversions, paying tax by choice rather than by surprise. A Roth conversion moves money from a pre-tax retirement account into a Roth account. The untaxed portion converted is generally included in income for that year. In exchange, qualified Roth withdrawals may be tax-free, and original Roth owners generally do not face lifetime required distributions under current federal rules. The phrase to remember is paying tax by choice rather than by surprise. A conversion may deserve consideration during lower income years after retirement before required minimum distributions begin. After a business loss, during a market decline, or when a family expects future taxable income to be higher. It may also create valuable flexibility for a surviving spouse or for heirs. But the word Roth is not magic. A conversion that is too large can push income into a higher bracket, make more Social Security taxable, increase Medicare premiums 2 years later, reduce the enhanced senior deduction, trigger an investment income tax on other income, or create a state tax cost. Paying the tax from the converted account can also reduce the amount that's left to grow. The right question is not, should I convert? The right question is, how much should I convert, in which years, from which accounts, using what money to pay the tax, and under what assumptions? A disciplined analysis compares several conversion amounts across the lifetime of both spouses and includes a no conversion baseline. One more critical point. Roth conversions made under current law generally cannot be recharacterized back to a traditional IRA. That makes careful sizing essential. A powerful strategy should be modeled before it becomes irreversible. To understand the value of acting early, we need to look at the tax bill hidden inside required minimum distributions. RMDs are minimum annual withdrawals from many traditional deferred retirement accounts. Under current federal rules, many account owners begin at age 73, whilst age 75 applies to people born after 1960. Traditionally, IRAs generally require distributions even if the owner does not need the cash. Roth IRAs and designated Roth workplace accounts generally do not require lifetime distributions from the original owner. Here's a simple illustration. If a 73-year-old has a $2 million traditional IRA and uses the current uniform lifetime table factor of 26.5, the first year RMD is approximately $75,472. That amount may be added to Social Security, pensions, interest, dividends, and realized gains. The account may continue growing, so future RMDs can remain substantial. The RMD itself is not a penalty. It is the end of a tax deferral bargain. The risk is waiting until age 73 or age 75 to discover how much taxable income the account may create. A family may have years between retirement and RMD age when income is temporarily lower. Those years can be evaluated for partial conversions, deliberate withdrawals, capital gain planning, or charitable distributions. The first RMD may sometimes be delayed until April 1st of the following year, but that can place two RMDs into one calendar year. Failing to take the required amount can also trigger an excise tax, although current law may reduce the rate when it's corrected promptly. A sound plan does not ask only, what is this year's RMD? It projects at least the first 5 to 10 years, tests different market returns, models the death of either spouse, and asks whether the account is likely to be inherited during a beneficiary's peak earning years. But RMDs are only part of the picture. The same income can create a ripple effect across Social Security and Medicare. Retirement income is interconnected. Depending on combined income, up to 85% of Social Security benefits may be included in taxable income. That does not mean an 85% tax rate. It means up to 85% of the benefit dollars can enter the tax calculation, causing the effective cost of an additional withdrawal to be higher than the stated bracket alone suggests. Medicare adds another powerful ripple effect. Higher modified adjusted gross income can trigger the Income-Related Monthly Adjustment Amount, or IRMA, for Part B and Part D. Social Security generally uses tax return information from 2 years earlier. which means a large conversion or gain in one year can affect Medicare premiums later. This does not mean every family should avoid IRMA at all costs. Paying a higher premium may be worthwhile if a Roth conversion creates a larger long-term benefit. The key is to count the full marginal cost before acting. That cost may include federal tax, state tax, Social Security taxation, Medicare premiums, deductions, and the effects on a surviving spouse. There is also an important relief mechanism. A person whose income falls because of a certain life-changing event, such as a retirement, a divorce, or the death of a spouse, may request a new IRMA determination. Knowing that process can prevent another avoidable surprise. Do your retirement projections include Medicare premiums and Social Security taxation, or only the federal tax brackets? Let us see what can happen when a strategy is evaluated in isolation instead of as part of the whole plan. Imagine you've recently retired and complete a large Roth conversion because you were told rates may be higher later. The conversion fits the tax bracket, but it doesn't consider Medicare, the senior deduction phase out, state law, or the surviving spouse's future filing status. 2 years later, you and your spouse receive higher Medicare premiums. The conversion also caused more Social Security to be taxable and reduced deduction that you were expecting to receive. The conversion was not necessarily wrong, the analysis was incomplete. Now, imagine instead that you're testing 3 conversion amounts. The first amount preserves the senior deduction, but barely reduces your future RMDs. The second crosses one IRMA tier, but produces meaningful lifetime savings. And then the third reaches a higher bracket and creates too much near-term cost. Now you can choose with clarity instead of reacting to a slogan. A credible advisor should be willing to show the assumptions, the break-even period, the cost if tax rates don't rise, and the outcome if one spouse dies earlier than expected. The goal is not to sell a conversion. It is to reveal whether the conversion solves a meaningful problem. That scenario leads to the key principle for the retirement withdrawal. Remember this: the timing and source of retirement income before mandatory rules, market events, or a change in marital status control it for you. Taxable, tax-deferred, and Roth accounts are not simply different containers. Together, they create options. The more balanced your tax flexibility, the easier it may be to respond to changing brackets, medical costs, market conditions, charitable goals, and the needs of a surviving spouse. Take a minute or two to connect this principle to your own withdrawal plan. Which accounts will fund your first 10 years of retirement, and what is the tax reason for that particular sequence? If the answer is simply we'll spend whichever account is easiest, that may be a sign that the withdrawal strategy has not been designed. Write down one question you want answered. How much should come from taxable accounts? Should we deliberately use the IRA before RMDs? When could Roth assets provide the greatest value? The objective here is not a rigid order. It's a dynamic policy that explains why each source is used and how the decision will be reviewed each year. Next, we will move from retirement income to the portfolio itself: gains, income, asset location, and charitable giving. So let's take a look at minimizing investment taxes by managing gains, income, and charitable giving. Here you're going to discover capital gains and tax loss harvesting. Keep more of your investment returns. Asset location, putting the right investments in the right accounts. Smarter charitable giving, appreciated assets, QCDs, and donor-advised funds. This section answers several frequently searched questions. How does tax loss harvesting work? Which investments belong in which accounts? And is it better to give appreciated stock, cash, or an IRA distribution to charity? We begin with the difference between market return and what you actually keep. Investment success should be measured after fees and after taxes. When a taxable investment is sold for more than its adjusted basis, the difference is generally a capital gain. Long-term capital gains on assets held for more than 1 year may receive preferential federal rates. Short-term gains are generally taxed as ordinary income, and higher income taxpayers may also face the 3.8% net investment income tax. Tax loss harvesting means selling an investment below its basis to realize a loss. The loss can offset capital gains. If losses exceed gains, individuals may generally deduct up to $3,000 against ordinary income, with unused losses carried forward. That sounds powerful, but loss harvesting is not free money. It often defers tax by lowering the basis of the replacement investment. The strategy also requires guardrails. A wash sale can disallow a loss when substantially identical securities are purchased within 30 days before or after the sale. Purchases in another account, a spouse's account, or an IRA can complicate the analysis. A brokerage statement may not identify every cross-account conflict, so coordination matters. The other side of the strategy is gain harvesting. A retiree with an unusually low income year may intentionally recognize a long-term gain at a favorable rate, increase the basis, and reduce a future tax burden. A family with concentrated stock may establish an annual gain budget instead of waiting for one enormous sale. Taxes should not prevent prudent diversification. A concentrated position can create more risk than the tax bill required to reduce it. The right question is not, how do we avoid every gain? It is, how do we manage gains intentionally while protecting the financial plan? Gain planning improves when each investment is also placed in the most suitable account. Asset allocation asks what you own: stocks, bonds, cash, real estate, and other investments. Asset location asks where each investment is held: a taxable account, a tax-deferred account, or a Roth account. The difference can have a meaningful long-term effect. Assets that generate ordinary income or frequent taxable distributions may be more efficient inside a tax-advantaged account. Broad, low turnover equity strategies may fit well in taxable accounts because they can provide long-term capital gain treatment, qualified dividends, tax loss harvesting opportunities, and charitable giving flexibility. High growth assets are sometimes placed in Roth accounts to maximize the potential for tax-free growth, but concentrating risk in a valuable Roth account is not automatically a wise decision. Municipal bonds are another common search topic. Their interest may be exempt from federal income tax and sometimes state income tax, but a tax-exempt label does not guarantee the best after-tax return. Credit quality, duration, state treatment, and the taxable equivalent yield all matter. Asset location must be managed across the entire household. If each account is managed in isolation, one account may hold tax inefficient assets, while another account uses scarce tax advantage space for assets that were already tax efficient. The portfolio should function as one coordinated system. The hierarchy is essential. Financial plan first, investment suitability second, tax optimization third. Tax efficiency should strengthen the strategy, never replace it. The same idea, choosing the right asset, can make charitable giving dramatically more efficient. For families who already intend to give, the method can matter as much as the amount. Donating appreciated securities held more than 1 year directly to a qualified public charity may allow the donor to avoid realizing the embedded gain and may create a charitable deduction, subject to applicable limits and documentation rules. Compare that with selling the security, paying capital gains tax, and donating cash. In many cases, giving the asset and using available cash to rebalance the portfolio can support the same charity while reducing tax friction. The tax benefit should amplify generosity, not manufacture a gift that was never intended. A donor advised fund, or DAF, can allow a family to make an irrevocable charitable contribution in a high income year, potentially bunch several years of deductions, and recommend grants over time. This may be valuable after a business sale, a large bonus, or a concentrated stock event. But DAF contributions are permanent. Fees vary, and the sponsoring organization legally controls the assets. For eligible IRA owners, a qualified charitable distribution, or QCD, is another powerful tool. A person who is age 70 and a half or older may transfer funds directly from an eligible IRA to an eligible charity. The qualifying amount can be excluded from income and may satisfy all or part of an RMD. Donor advised funds generally are not eligible QCD recipients. This is why writing a check from the bank account may be the easiest method to give to charity, but not always the most effective. A coordinated giving plan reviews cash, appreciated securities, retirement accounts, deductions, RMDs, and the family's charitable calendar all together. Let us place these investment and giving decisions into one realistic scenario. Imagine you plan to give $50,000 to charity. You write a check, then later sell appreciated stock to replenish the cash. The sale creates a large gain, even though the charity could have received the stock directly. Now, imagine the alternative. The charity or donor advised fund receives the appreciated shares. The embedded gain is not realized by you, the charitable goal is fully funded, and available cash is used to rebalance the portfolio. The family achieves the same generous outcome with less tax friction. Or imagine an IRA owner who writes charitable checks from a bank account while taking a fully taxable required minimum distribution. A properly executed QCD might have satisfied part of the same charitable goal while reducing adjusted gross income. Again, the strategy depends on eligibility and execution, but the opportunity begins with one question: which asset should fund the gift I intend to give? When investments, taxes, and generosity are coordinated, the giving can feel more powerful because more of the family's intention reaches the cause. That leads to the key principle for investment tax planning. Measure investment success after taxes and make generosity more powerful by giving the right asset from the right account. Tax efficiency is not about chasing clever transactions. It is about preserving more of each return, managing gains intentionally, and aligning money with purpose. The most effective plan may combine investment discipline, careful basis records, year-round monitoring, and a charitable strategy that reflects what your family already values. Now, consider whether your current portfolio process delivers that type of coordination. Are your investment, tax, and charitable decisions coordinated for after-tax impact, or are they handled by different people at different times? Write down the asset that deserves the first review. It may be concentrated stock, a mutual fund with recurring capital gains distributions, a large cash position, municipal bonds, appreciated real estate, or the account currently funding charitable gifts. One focused review can be more valuable than a long list of disconnected tactics. Our final major section: asks how the tax character of your wealth affects the people who inherit it. This section, titled Preserving Your Estate, Protect Your Legacy to Leave More for Your Family. It covers lifetime giving versus step up in basis. Which assets should you give or keep? Trust and beneficiary strategies, directing wealth more tax efficiently. And inherited IRAs, reducing the tax burden that you leave behind. This section addresses the questions families often search when planning a legacy. How much can I gift? What is a step up in basis? Should a trust be a beneficiary? And how will my children be taxed on an inherited IRA? We begin with a decision to give an asset during life or retain it for a potential basis adjustment at death. One of the most common questions is, how much can I give my children without tax? The more important question is often not how much to give, but which asset to give. Appreciated property transferred during life generally carries the donor's basis for determining gain, subject to some detailed rules. If the recipient sells, the embedded gain may become taxable. Property inherited at death generally receives a step up in basis that's tied to the fair market value at death, although important exceptions apply. This creates a powerful trade-off. Lifetime gifting can remove a future appreciation from an estate, support family members when the money is most useful, and allow parents to witness the impact of the gift. But gifting the lowest basis assets may transfer a large future tax bill. Retaining that asset may preserve a potential basis adjustment, while cash or high basis property could be more efficient to give. Direct payments of qualifying tuition or medical expenses may receive separate federal gift tax treatment when paid directly to the institution or provider. State tax rules, Medicaid planning, creditor concerns, control, cash flow needs, and family fairness also matter. A tax-smart gifting plan ranks assets by basis, growth, income production, estate inclusion, liquidity, and personal importance. It does not begin with the largest number on the statement. It begins with the family outcome. Gifting decides what moves. Trust and beneficiary instructions decide how, when, and under whose control it moves. A trust is a legal arrangement, not a tax strategy by itself. A revocable living trust may help avoid probate, support incapacity planning, and provide continuity, but assets are generally still treated as the grantors for federal income and estate tax purposes. Creating the trust does not automatically reduce taxes. Irrevocable trusts may transfer assets or future appreciation outside of an estate, protect inheritances, support charitable goals, or create multi-generational stewardship. But those potential benefits can require surrendering access or control, filing gift tax returns, maintaining separate records, and dealing with compressed trust income tax brackets. Complexity must earn its place. Beneficiary instructions can be even more decisive. Retirement accounts, life insurance, annuities, transfer on death registrations, and payable on death accounts generally follow their beneficiary forms or account contracts, not the will. One outdated form can redirect both the asset and its tax consequences. Naming a trust as beneficiary may provide control or protection, but retirement account rules require specialized drafting and administration. Naming the estate can create delays or less favorable distribution options. A spouse, child, charity, or trust may each receive different tax treatment. Life insurance can provide income tax-free death benefits under general federal rules and create liquidity to pay expenses, equalize inheritances, or preserve illiquid assets. But Ownership can affect estate inclusion, and an irrevocable life insurance trust introduces additional duties and restrictions. The right strategy starts with the problem: tax reduction, creditor protection, remarriage protection, special needs, business succession, charitable giving, or family governance. Only after the problem is clear should the structure be selected. The most urgent beneficiary issue for many affluent families is the income tax inside inherited retirement accounts. For many families, the largest legacy of tax exposure is not the home or brokerage account, it is the traditional IRA or 401k. These accounts generally do not receive a basis adjustment that eliminates ordinary income tax. Beneficiaries usually recognize income as distributions are taken. Under current federal rules, many non spouse designated beneficiaries must fully distribute an inherited retirement account by the end of the 10th year after death. Depending on the owner's status at death and the beneficiary category, annual distributions may also be required during that period. Eligible designated beneficiaries, including certain spouses, minor children of the owner, disabled or chronically ill individuals, and people not more than 10 years younger, may have different options. So imagine a child, your child, in the highest earning decade of a career, and they inherit a large traditional IRA. The 10-year window can layer taxable distributions on top of their salary, bonuses, investment income, and state tax. Waiting until year 10 may create a very concentrated tax bill. Taking equal annual withdrawals may not be optimal either. The distribution plan should be modeled. Potential planning tools include partial Roth conversions during the owner's lifetime, thoughtful beneficiary selection, naming charities for some pre-tax assets, balancing retirement accounts with taxable assets that maybe will receive basis adjustment, and using life insurance or Roth assets to create a tax-efficient liquidity. Trust beneficiaries require careful drafting. The objective here is not to make every heir's tax identical. It is to match each asset with the person or cause that can receive it most efficiently while honoring the family's priorities. Let us see how gifting and inherited retirement accounts can collide in one. Imagine one child inherits a $1.2 million traditional IRA during their peak earning years. Another receives $1.2 million of taxable investments with a potential basis adjustment. On paper, the gifts are equal. After taxes, they may not be. The first child may need to distribute the inherited IRA within 10 years and pay ordinary income tax. The second may be able to sell inherited investments with far less embedded gain, depending on basis and market movement. Equal account values can produce unequal spendable wealth. Now, add a lifetime gift of low basis stock. The child receiving that stock may also receive the donor's basis. The family intended fairness, but the tax character created a different result. A coordinated legacy map looks beyond account balances. It identifies who receives each asset, the legal mechanism controlling the transfer, the likely tax treatment, the timing rules, and whether the recipient has the skill or protection needed to manage it. That is how a legacy becomes more than a list of names. That scenario leads to the central principle of tax-smart legacy planning. A tax-smart legacy protects both the people you love and the tax character of what they receive. The most valuable asset is not always the best asset for a particular beneficiary. A strong plan coordinates basis, income taxes, distribution deadlines, trust, beneficiaries, liquidity, and family readiness. It asks not only who receives the wealth, it asks what will that wealth become in their hands. Now, connect that principle to your current estate plan. Are you leaving your family a collection of accounts or a coordinated plan for how those accounts will transfer, be taxed, and protected? Write down the first item that needs verification: basis records, beneficiary forms, inherited IRA projections, trust language, life insurance ownership, state estate tax exposure, or family communication. You do not need every single answer today. You do need to know which questions could become expensive if they remain unanswered. So now we're going to bring the entire webinar together and turn today's knowledge into a practical next step. At least periodically and after major life, tax, family, or financial changes, review your current tax strategies, including your income and investment taxation and your retirement account tax exposure together to identify new tax saving opportunities. A tax plan that does not evolve with your life may leave your wealth exposed. We all know that knowledge is only useful if it's applied. So last but not least, we'll review how to turn today's knowledge into action. You'll discover the top 5 most common tax planning mistakes to avoid, key questions to ask before your next major financial decision. Your next step: find the hidden tax exposure in your financial plan. Here we will identify the mistakes that create the most avoidable exposure, review the questions to ask before acting, and define a clear next step for families who want a personalized analysis. Let's begin with the coordination failures that most often undermine good intentions. The first mistake is planning only one tax year at a time. The second is treating every dollar as equal, even though taxable, tax deferred, and Roth assets can create very different outcomes. The third is completing a Roth conversion without counting Medicare, Social Security, state taxes, and the surviving spouse. The fourth is allowing taxes to prevent necessary diversification. The fifth is giving cash while holding appreciated assets that could support the same charitable goal more efficiently. The sixth is making large lifetime gifts without reviewing basis. The seventh is assuming a trust automatically reduces taxes. The eighth is allowing beneficiary forms, legal documents, and account ownership to conflict. The ninth is letting the financial advisor, CPA, attorney, and insurance professional work in separate silos. The 10th is treating the plan as a one-time transaction instead of an ongoing living strategy. Notice that none of these mistakes requires an exotic loophole. They're coordination failures. That's very encouraging because coordination can be improved. The best protection is knowing which questions to ask before a decision becomes final. Before taking a large withdrawal, ask, what is the total marginal cost, including Social Security and Medicare? Before a Roth conversion, ask, why this amount, why this year, and what happens if tax rates do not rise? Before selling an investment, ask, what is the basis, the holding period, diversification benefit, and net investment income tax exposure? Before giving to charity, ask, which assets create the greatest after-tax impact? Before gifting to family, ask what basis and future tax liability will the recipient receive? Before creating a trust, ask, what specific problem does it solve? What control is surrendered, and how will income be taxed? Before changing a beneficiary, ask, how does that person's tax situation and legal protection affect the result? Finally, ask, who is coordinating the entire decision and which assumptions have not been tested? These questions do not require you to become a tax expert. They help you recognize whether the advice is complete. Ask yourself this: which of these questions has not been answered clearly in your current plan? If today revealed a meaningful gap, the productive next step is diagnosis, not immediate implementation. Imagine 1 year from now, you know which accounts will fund retirement, which assets should be sold or donated, how future RMDs may unfold for you, and what each child is likely to inherit after taxes. You do not have to have a perfect prediction, no one does, but you have a living map, a clear owner for each decision, and a process for reviewing the plan before deadlines. Your spouse knows whom to call. Your professional team is working from the same assumptions. Your family is not relying on hope or scattered documents. That is the emotional return of strategic tax planning. Not merely a lower number on one tax return, but greater confidence that your wealth will support the life and legacy that you intended. That brings us to our final principle. Diagnose the exposure, quantify the impact, compare the trade-offs, and only then choose the strategy. The most sophisticated plan is not the one with the most moving parts. It is the one that solves a meaningful problem, can be administered well, and remains aligned with your family's goals. Now, let's return to the number you wrote at the beginning. Remember this? At the beginning, I asked you to rate the coordination of your plan from 1 to 10 and write it down. So let's consider that number again. Did your number rise because you recognized strengths in your plan? Did it fall because you discovered a hidden exposure? Either result is useful. Better decisions begin with honest clarity. Now write one final sentence. The first gap I want reviewed is blank. It may be RMDs, Roth conversions, IRMA impacts, capital gains, charitable giving, basis, beneficiary instructions, inherited IRAs, or professional coordination. One precise next step is more powerful than 10 vague intentions. Let me close with one final thought. What is the single most important gap you want reviewed? For some of you, today's teachings may simply confirm that your plan is in good order. For others, it may have revealed a gap between what you want and what your current structure could actually deliver. Now it's time to take action and review your plan for hidden risks and opportunities. If you would value a second set of eyes, we're offering a custom tax planning risk and opportunity report to our webinar students so you can get clear today on your personal areas of opportunity and see exactly where you're left open to risk. The report shows you how to organize your financial picture, identify probate exposure, review trust funding, uncover dangerous gap areas, and prioritize your next steps. You cannot control every future tax law, market return, or family event. You can control whether your plan is coordinated, reviewed, and adaptable before deadlines force your hand. Thank you for investing this hour in your financial future and your family's legacy. The 3 steps to receive your custom report. Number 1, reserve time with a tax planning expert in order to gather the information required for your report. Collect copies of your investment statements, your most recent tax return, and list of all assets. And number 3, write down your personal tax planning concerns, goals, and objectives. Because we prioritize creating high-quality reports for you, this link will be available for only 24 hours following this presentation. To get started, simply scan this QR code with your phone's camera to access the link to reserve your free report. Or you can type directly into your web browser, financialclass.info/free-tax-report. Now these spots do fill up fast, so pause here if needed so you can make sure your spot is reserved. Thank you again for joining us. For additional questions involving your personal tax planning areas, please email us at education@stripmatterwealth.com. Have a wonderful day and happy planning.